And then you drill down into the property. Assuming you pass the litmus test of and like to trust the sponsor, then you drill into the property. So what type of asset is it? I mean, ABC type of year of build. What's the comps in the market? Is it a value add deal? Is it a yield play? You have to begin to learn underwriting if you're going to invest versus speculate.
Welcome to the Real Estate Mindset Podcast, hosted by Eric Nelson and brought to you by Wild Oak Capital. Eric is a real estate investor, business owner, and performance coach. Throughout this series, Eric explores the mindset behind why certain investors are so successful and how we can learn from their achievements and failures. Eric asks the tough questions around the habits, discipline, mindset, and more required to achieve the most ambitious goals. Thank you for being here and enjoy the show.
Hey everybody, welcome to the Real Estate Mindset Podcast. This is your host, Eric Nelson. Tonight, Randy Langenderfer. Did I say your last name, Randy?
You did. The first time, and we didn't even rehearse it.
I know. I've got some luck, I think, on my side. But anyway, we have tried to record this a handful of times, so I'm glad we connected. Thank you so much for being here.
Eric, it's my pleasure, and I look forward to chatting and getting acquainted with you and hopefully provide some value to your listening audience.
Oh, I'm sure you will. So I guess I always start out, same way most podcasts. If you could kind of give us your background, where you started, where you came from, and then how did you get to real estate?
Well, happy to do that. So Randy Langenderfer, today I'm based in Houston, Texas submarket on the southwest corner, Sugar Land area. I'll start with where I'm at and kind of go backwards. So today I am InvestArk Properties is my company, and I'm actively seeking to identify, acquire, and operate multifamily properties, primarily in Houston, Texas, and San Antonio is the markets we're focused in. JV partners, but really just trying to find properties that we can all add value to our investors. Been in multifamily since about 2014. Prior to that, I got started in the single family flip business. I was living in the Cleveland, Ohio market at the time, and I became a hard money lender, a brother-in-law and I, and he taught me the power of the self-directed IRA, and started doing flipping, came to Houston for business purposes, reasons, got introduced to the Lifestyles Group, a large educational group here in Houston, Texas. Spent some time there, spent about 3 years in Brad Sumrock's organization in Dallas, learned underwriting, team building, all the professional contacts I needed. And currently I participate in Rod Khleif's mastermind, and I'm a coach in his organization. So Eric, I really enjoy talking with people about real estate. My wife says I'm kind of just a nerd, and I'll talk to anybody anytime about it. And she always also tells me that I need to give credit to my family. So I'm a husband. I have 4 children, 3 adult children, some grandchildren, and a 20-year-old son that still lives at home with us, still actively employed, a W-2 employee for a large integrated, an academic medical center here in Houston, Texas, And that about 250 doors as a KP, GP, and I've been in several thousand over the years as an LP. So I think I'm a better general partner because I've had that experience as an LP, and I will always invest some of my assets in LP because I just still like this asset class. So that's a long-winded explanation, but
no, it's good. There's a lot in there. So I guess let's start with maybe your background as an LP, and I tend to agree. I mean, I have a confession. I've never invested passively in a group. And I'm, basically working to be a GP, right? So we're going to close our first deal here shortly. But I do believe that when I talk to people who have done that, it's kind of nice to have that background. It seems like it gives you an education as to what it looks like to be a passive investor. Do you agree? I mean, you kind of mentioned that. Do you think that most GPs should have that experience as an LP first?
I don't know. I don't say you have to have it. It worked for me. I think everybody's different. So I've seen people go from 0 to a couple hundred units right away. I've seen it just, everybody's got to decide where their comfort risk level is. I was still working, still am working a W-2 job when I first came to Houston, learning about multifamily. Quite honestly, I was just uncomfortable putting down that kind of capital that I had to do to become a general partner. And so I decided to get educated. And, a lot of these groups want big money up front. And I kind of refused to pay the pay to play model, and just said, I'm going to invest in properties and get to know sponsors and get to know, so I can pick and choose the best that I see. And while I continue to work and gear up for hopefully doing this one day full time. So I think it's a proven strategy. There's a lot of people that want to start out doing. I have a really good friend here. He wants to start out doing quadplexes and 10 doors and 20 doors. And I said, why? It's as much work to do 10 doors as it is 100 doors. But that's his comfort spot. So to your listeners, if you're wanting to dip your toes in the water, that's the place to start and to understand the business.
Yeah. And actually, that's kind of where I got my start as well. And for some, I think there's lots of reasons why maybe those smaller doors actually do work. I do think it's, it's quite a different animal to syndicate it, is what I'm finding, rather than just partner with a handful of folks, or maybe you could get creative with financing, whatever it might be. So I tend to agree. I think whatever works for each person, and it's cool to hear you say, that it worked for you. And then let's back up a little further. So you talked about flipping, and then hard money lending. So are you still doing that? Have you kind of worked your way out of that? What are your?
No, so the backstory on that one is, as I was living in the Cleveland, Ohio market at the time, and this takes us back to about 2000, and I was doing it from probably about 10 to 13, 2010 to 2013, maybe 2009. Had a brother-in-law who was a very well-educated, very smart guy, JD, MBA, came to me, and he had met this group out of South Florida. We're living in Cleveland, Ohio, and he said, we're going to provide the hard money for these people to buy houses, flip them. And I said, we don't know these people. We're going to give them money for a house that we've never seen. And oh, by the way, he wanted me to use my self-directed IRA. He goes, yep, we're going to make lots of money. We made really decent money. I wouldn't say we got rich, but so that was my entree into the hard money lending. And we did that for several years, and in that time period, coming off of the Great Recession, it wasn't hard to find assets that were deeply discounted. For that model to work, you really need to find a deeply discounted model and then, buy it, rehab it. But what I really learned as I came to Houston, I joined the lifestyles I mentioned. I did it 3 or 4 times here in Houston, but with a new job, new relocation, all this stuff, I just really found that it was time consuming to meet new people, to build the network, to learn the different metro markets within the Houston area, to look at the repair values, become comfortable with what the operator was going to do and the repair values and the market values and all that stuff. It just became very busy and more than I wanted to do. And when I learned multifamily and said, gee, this is busy for 6 months, 9 months, maybe before it, but then after that, it can end up on autopilot for 4 or 5 years where you're getting that mailbox money. And I just really have never looked back. So.
Yeah, no, I love what you have to say. And the other thing that you mentioned earlier was education. And that to me is key. I love education so much. That's the reason I started the show. For lots of reasons, but that's a big reason. And so you talked about 2 different programs, and Brad Sumrock's huge, of course. Rod Cleef, I know a lot of people in that program.
Yeah.
I don't want to necessarily bash one or the other. It's certainly not going to compare, contrast too much, but I will ask, did you have a good experience with both of them? And
had a good experience in all 3 of them, Lifestyles, Sumrock, and Khalif. And I, like you, there's something to be learned from all of them. There are similarities in all of them. They provide a great ecosystem for the newer people. I would say, I think the Lifestyles group has, since I was there, and that was, 2013, 2014, at that time was very Houston centric. They had a great following in Houston. They've since diverse, and Sumrock the same way when I was there in 14 through 16. it was very Dallas centric. They were looking at Dallas deals a lot. And I think they've also branched out as well since then. I really haven't stayed in touch. But that's, I would say, the advantage of Rod's group is that it's much more nationally focused all across the country. And his lack of a better word, following is much more geographically diverse. Other than that, I mean, there's a lot of similarities to all of them. They all have the boot camp. They all have I'll say it, the attraction to the first time person, or the person who really wants to get involved. And then you can escalate up into their programs as you choose fit. And Eric, like you don't have to go that way. I think it jumpstarts it. And you don't have to have the large pay to play. There's so many today, great podcasts like this one. There's meetups in your local market, wherever you're at, whatever geographic market you're in. Tons of books out there. My wife, we get in the car now and she says, Randy, can we please not turn on a real estate podcast?
Yeah, it's either podcast or book for me too. And my wife will not have it anymore. So
said, can we just listen to some music, some kind of music? Okay, babes. But my point of it is constant education, right? Wherever you're at. And whether I've been doing this for 6-7 years and you've been doing it for a couple of years or more, and wherever you're at, the networking alone is worth those organizations. And there's there's Michael Blanc, there's Jake and Gino, there's Mark Kenny. I could name more if you just pause. They all have their advantages and disadvantages. It just kind of where you see yourself clicking. And but you're not going to find deals sitting behind the computer like this analyzing deals, right? And you have to go out and network and make friends and acquaintances and find professional contacts. And it's just as you know, it's a team sport.
Yeah, that's one of the things. Yeah, I mean, that's one of the things I love about the industry. Really, is it's such a team thing, and regardless of the program you're in, I mean, I agree. I think it's worth asking some people who've been in there, their experience, and then it comes down to the coach as well too. Because a lot of these programs, like you mentioned, you're a coach for Rod, and a lot of these programs come with that coaching, and that's huge. But you need to know that coach works for you as well. And so I think it's kind of ask people, figure out what's the best for you. Like you said, you don't have to necessarily do that. I actually never did pay a big program. I did get super lucky to find a coach. And then I found him at the local meetup. So the two things you mentioned, a local meetup, and then, just connecting with people. That's really key, I think, to get you kick started, of course.
Might have cost you a lot of coffee or lunch, breakfast meals, but
but a lot of coffees. Yeah.
I bet it was the best money you ever spent.
Oh yeah. And I mean, I think it comes more naturally to some people. I mean, to me, networking and talking to people is really what gets me excited beyond the deal. I mean, I really believe in the asset class, just like you, but it comes a little naturally for me. So it's not really necessarily a chore. I love to just talk to people in general about real estate. I'm like you.
And even if you're an introvert, I would say there's room for you in this industry. I would say that's where you pair up with an extrovert and you become the analytical person, man or woman behind the scenes. I'm paying right now for the University of Houston graduate student to do our underwriting, our first blush of underwriting. Great analytical type. And, so there's room for every personality. Every group needs a marketer. Everybody needs a marketer. Everybody needs a money raiser. And you may not think you can raise money, but if you put your mind to it, I think you'd be surprised how many friends, family, and acquaintances you have.
It's actually I totally agree. I didn't mean to cut you off there, but I think one thing I was talking with a friend about last week was, we say this a lot, is I think the majority of people have never even heard the word syndication. If you ask the average person in the US, I mean, I have ventured to guess it's a pretty small number. And the reason I say that is important is because we're solving a problem, because people have not a lot. I mean, people have money that they want to invest, right? If they worked hard for it, they want that money to work for them. And most people aren't aware of this type of scenario where they can actually give their money to an operator who's a professional. That's what they do. This is what they've learned, educated in. And basically, like you said, get mailbox money. And it's kind of solving that problem to be able to invest in real estate in a path that isn't necessarily this crazy difficult thing. As a passive investor, the number one thing you need to do is vet the deal and vet the sponsors. And then beyond that, you invest and you're along for the ride. And I think it's one of these things that it kind of, I mean, I believe in it so much that, like you said, it's not out of the question to believe that most people could raise money without question. They start talking about it.
Yeah. And I have a high net worth friend that I've been trying to come alongside of me, and he has a lot more money than I do. And we've been talking about asset allocation. So I'm a finance guy at heart, an MBA, a CPA, doesn't mean anything in real estate, but trying to get him, and he has a money manager, and he talks about bond equity allocations and high growth, low growth, and domestic, foreign, and all these different allocation thoughts. And I asked him, I said, so where do you put real estate in your asset allocation? So recently the organization I work for has a $2 billion endowment. And I was sharing with my friend, the high net worth friend, that the asset allocation for $2 billion is about 54% equities, about 30%, 25% bonds, and 10% real estate, and 10% private equity. And you could kind of mix those together. So my point of it is, even if you have a lot or a little, you really should consider this asset class for a portfolio diversification. History has shown wealth has been created an awful lot of people by real estate. I can only think of Warren Buffett off the top of my head, who has wealth created by investing in companies. I'm sure there are more, but he's the biggest one that I can think of. But I can name many that wealth has been created by real estate. So allocate a portion of your net worth to real estate, be it small, be it large, whatever you're comfortable with. Get to know the Erics of the world and the Randys of the world. And I think it's slow and steady wins the race. You may not make $1 million in your first deal, but it's going to be a handsome reward because, we do it for cash flow, appreciation, and favorable tax advantage. 3 big advantages to real estate, and specifically multifamily.
Yeah, I agree. And I think the one thing I'd tack onto that would be in an economic downturn, in my opinion, I mean, there's lots of ways to view it. I believe it to be a safer investment than a lot of other ones out there. And the reason I say that is because you can just kind of hang on. Rents are still very likely going to come in, especially in a B class, C class type property. Right. And you can sort of hang on, right? So you can wait until the market turns back around. And when you invest in these properties, especially as a passive investor, I mean, it needs to be illiquid. It needs to be, you need to understand it's in there. Point of that being that cash likely has the ability to survive a pretty rough downturn. And it's not terribly common these businesses just completely fold if the operators have their ducks in a row and are kind of prepared for that type of thing. So I'd kind of tack that on as one more benefit.
That's great. And I agree with you. It is in a downturn, I think history shows that those hard assets, of which real estate is, are going to perform better, and they're going to bounce back quicker than the bond equities market. And those hard assets, as we said, somebody's always going to need a place to live. As long as they're human beings, they need a place to live. They may not need Amazon and its delivery service as much. That trend has probably changed forever.
Yeah, I don't think a lot of Americans can live without Amazon anymore. But yeah, I get your point.
That's probably a bad illustration as I utter that. But yes, the point of it is people are always going to need a place to live. They may not need to invest in equities or bonds or whatever, but they're going to need a place to live. So, and we are, the statistics show we are becoming a nation of renters. I'm sure you've read, and it's
Seeing it
sad
more and more. Yep.
as the disparity between kind of those the haves and the have-nots with money to afford a down payment will buy a house, but those lending requirements are much stringent today than they were previously, and it locks a lot of people out of buying a house, and a lot of people don't want to live in the suburb like myself and mow lawns and have maintenance. We're looking at a beautiful Class A asset near downtown, and it's I said, that's the kind of asset I want to live in about another 7 years, 8 years, when I get tired of the maintenance and just move to an asset that's close to everything and I can Uber or walk.
Yeah, no, there's a huge draw to it. I mean, I was telling you, I was in San Antonio yesterday, and I tend to stay downtown so I can try and see the city, what it's like, kind of feel that downtown, and then, go to the property we're looking at, properties. And, it's really fun to be downtown, and it's kind of nice to think, wow, it'd be kind of just pretty cool to live down here, whenever I have young kids. So it'd be a little bit challenging at the moment, but yeah, there's definitely a draw to it for sure. I mean, if you're in that part of life, then I could definitely see it. No problem.
That's a way cool city to live in. And with downtown,
yeah, I really enjoyed it.
It's
my first time spending time there.
Okay.
And I really loved San Antonio. So yeah, let's move on to your InvestArk. I mean, could you tell us about your portfolio now? I know you mentioned the doors, but what are you doing there, and where are you guys?
So InvestArk is the company that I say I have a day job, but it's my passion. It's where I spend all my nights and weekends. We're JV'd with a couple of different people here in Houston and a couple different groups, and we are very actively out seeking to identify, acquire, and operate multifamily. And as I said, in Houston and San Antonio. So we've built kind of the back house a little bit with underwriting people and VAs. 3 of the 4 still work full time, and 1 of them doesn't. And we're really underwriting like fools and trying to be rational in a very competitive market. As you know, you're in San Antonio as well too, and it's just a little craziness out there. But convinced there's still opportunities out there. I still GP and 1 other asset in Columbus, Ohio, and as I said, I actively manage my passive portfolio. So I, as I said, started out there. I have several thousand doors, about 10 different properties, Ohio, Texas, Louisiana, Atlanta, or Georgia, I should say, state. So different sponsors, different size, A, B, C classes. So I try to spread my risk that way, taking my corporate thinking from risk mitigation to different geographic market, different sponsors, different types of assets, of what I think I'm creating my own little portfolio.
No, that's awesome. Yeah, thanks for sharing. I think, for listeners who are looking to be passive investor, I mean, this could be really, really valuable information. Would be, how do you vet your sponsors? So let's say you have a little bit of cash, like, okay, I'm ready to jump in, as a JV. What are the questions you ask, just so our listeners could take a little away from you?
Yeah, and that's really spot on. The 2 biggest things any passive investor should do is, as you said, vet the sponsor, know the sponsor. You invest with those you know, like, and trust, right? You invest with those you know, like, and trust. So you need to find somebody that you know, that you like, and that you trust. So let me also start out with saying, I believe there's no such thing as a truly passive investment. I believe that there's a difference between investing and speculation. So speculation is when Eric's got a property and I send him $50,000 because I met him at a conference and I liked him. Investing is when you understand, you know the sponsor, you understand the sub-market where the asset is, what it is, what its business risks are, what are the business risks, and you make an informed decision based upon those risks. That to me is investing. So back to your thing, the first thing is find sponsors and ask to see deals. I did it through the Sumrock and the Khalif organization, meeting people and hearing other sponsors. You'll be amazed in this market that if you get your name on a couple lists, you'll soon start getting inundated with offers to invest. Because with the market where it's at right now, there's just a lot of deal activity, as you know.
Yeah, and like you said, I mean, I think there's a lot of deal activity, but I also believe it's a little bit dangerous because I have to admit, I think I see people overpaying because we're a lot like you. I mean, we underwrite. I'm kind of scared to say the number of deals we've underwritten. And,
it's embarrassing for us too.
Yeah, I mean, it's because we're not going to compromise, right? I mean, we're not going to fudge numbers and they don't lie. But I do think it's a little bit of a challenging time. And so that's a really valuable thing to say is it needs to be, of course, you need to know, like, and trust your sponsor, just like you said. And I think it's worthwhile to ask as many questions as you possibly can. And I actually kind of enjoy that. When I am talking to an investor and they ask some questions, the more the merrier, because they really are an owner in the property. That's the way I see it. So everything should be extremely transparent. Every question as a passive investor you can possibly ask, lay it on me. That's kind of my view as a GP.
I mean, you're going to ask, first and foremost, you're going to ask some of the, well, let's get to the nitty gritty, Eric. I mean, you're going to ask, what's the person's track record? Is this their first sponsorship or is this their 100th sponsorship? What's their number of assets gone full cycle that they can show to you that have gone the full process from buy to sell? What is their track record on distributions, their history of paying distributions according to pro forma? So there's a lot of people that show some wonderful pro formas, but they miss them, and they might catch up in the end, and they could. So, and then you start asking about, you want to do some background check on these people. Ask others. If you're so inclined to do a formal background check, I've never done that, but I have asked people, hey, what do you know about Eric? You ever know about Eric Nelson in Colorado? And you'd be surprised. It's a big world, but it's a small world, especially if you get in the same ecosystem, Khalif or Sumrock or whatever, and you'll quickly get some feedback from those in the group, and look at their websites. What are they doing? What kind of educational materials are they doing? And then you drill down into the property. Assuming you pass the litmus test of and like to trust the sponsor, then you drill into the property. So what type of asset is it? I mean, ABC type of year of build. What's the comps in the market? Is it a value add deal? Is it a yield play? You have to begin to learn underwriting if you're going to invest versus speculate. You have to begin to understand some of the implications of the assumptions in everybody's underwriting process. Eric, I always love to say, have you ever heard a sponsor say, "Oh, I underwrite very aggressively"?
No, but that's hilarious. But no.
No, and you never will. But everybody will say, "I underwrite very conservatively." Well, what the heck does that mean? Because your conservative may be my aggressive or assertive.
Yeah.
And there are certainly implications of that when you start understanding the underwriting process. What are the rent growth and expense growth assumptions in the model? What is the reversion cap rate? In Texas, you got to really understand taxes and insurance assumptions. They have dramatic outcomes in the pro forma, and you're a seasoned guy, and I can create a spreadsheet that looks great, world class, 10, 20, 30% IRR or whatever. But the reality of hitting those pro forma assumptions is the business model. And so drill into what the business model is. How are they going to get the rent growth? How are they going to shave the expenses? How do they think they can do that? Maybe it's a mom and pop operator that you're buying from, and we're going to put professional management in. So there's hundreds of different ways to do it, but focus on the operator and focus on the business plan or the underwriting assumptions. Oh,
that's such a good tip. Yeah. I mean, a lot of those things you mentioned in there are something I always key on. I mean, I see underwriting where the exit cap is the same as the entrance, those type of things. I'm like, that's kind of scary. Or they're underwriting to a refi at the that the rates are the same or better as they are now. I mean, that's foolish. We have no idea what's going to happen. We really have to assume that they're going to be worse. Those type of things are kind of red flags to me. Totally understand or agree with what you're saying. I mean, that's such a good tip.
You're making that as an informed investor, though. So those data points. And I always say there's nothing wrong with any of the things you just said, because maybe the person has a lot of experience in that refinancing world or that specific submarket. They know the cap rates better than I do. But all I'm encouraging your listening audience is to be educated, back to where you started, and to make an informed investment decision.
Yep, that's a great tip. I mean, I agree. If you can, the more you can learn about it. And like you said, there's a lot of podcasts. I mean, there's a lot of really good information out there that you don't have to pay a ton of money to do. And then the other thing was just ask people, ask your friends, ask your operator, say, hey, what should I be looking for? And, then ask another operator and see what they say, that type of thing. So I think there's lots of ways to get educated, but yeah, I completely agree. If you're going to be an investor, if you want to dive into this lot, I'd encourage you to consider tons of podcasts, books, all that stuff. Totally agree.
I just was this last weekend, I offered to go into a deal as a GP for I happen to know the asset very, very well here. It's actually about 1.5 miles from my house, brand new Class A. I was really excited, but I'm not really excited about my fellow sponsor, and I'm not going to join because there's just a difference of philosophy that's really not worth going into. But I can't join because we're not equally yoked, and I'm not going to do that to potential investors to say we're going to give you this kind of return, and it may or may not happen. But I want to, like you, be able to look them in the eye and say, I'm betting my own money on this, and I'm really confident we can do this.
Yeah. So you touched on two things there, and that's happened to me twice as well, where I've got invited to be a GP and I passed for basically personal reasons. It was like, maybe nothing wrong with the deal, maybe nothing wrong with any of it. I just had this gut feel that we weren't quite aligned. And so that's really important, I think, too, is exactly what you said, is to provide an honest opinion. Look the investors square in the eye and say, yes, I 100% believe in this. And the other thing you mentioned was skin in the game. So, we have this kind of philosophy that if we're going to have a property as GPs, we want to all have our own cash in there as well. And that can be challenging, but I think it's important because that question gets asked a lot is, are you investing as well? And if the answer is no, maybe there's a reason for it, right? It doesn't have to necessarily be every time, but
there's a little tip there for your investors too. Today, this day and age, it's very common to have acquisition fees. And so you almost have to ask the question, what skin do you have in the game beyond your acquisition fee?
Great tip.
Because a lot of sponsors will roll over their acquisition fee that they're earning for raising money into the deal as a passive, which is a statement true that they have their own money in the deal, but they don't have out-of-pocket cash in the deal. And so I can take my future earnings and put them in the deal as a sponsor versus me putting my own hard-earned pre-money into the deal. Very different.
Yep, that's a great tip. Well, Randy, we're going to move to the second part of the show. It's mindset based. So I'm going to just kind of sling a bunch of questions at you.
Oh boy.
No right or wrong answers, so don't sweat it too much. The first one I always ask is, do you have a morning routine?
I do. I get up every morning, and I am, hope I don't offend anybody, I'm a person of faith. So I get up every morning and I have a quiet time. I read scripture and journal, and then I try to have a cup of coffee with my wife and spend 10 minutes with her before our days get too crazy.
Oh, I love it. Yeah, I think, again, I share the same faith as you, and I think it's important to just spend some time, before, this is what I always say, before my kids get up, before my wife gets up, spend some time really kind of thinking about the day and prepare. So again, there's no right answer. I like to ask that question because everyone's
especially with you with young kids, you need 10 minutes.
Oh yeah. I need at least 10 minutes. I love the time, but yeah, the quiet time to prepare for it is super valuable.
Yeah.
Cool. The next question I ask is, what books are you reading, or what books can you recommend?
Got several. Looking up, what is it? I still like, I've recommended a couple times, Master the Market by Howard Marks. Master the Market by Howard Marks is a great book. He is a former money manager for, I think it's Oak Investments or one of the big mutual funds. And he talks about the different cycles, and he doesn't give direct implications, but he talks about recognizing where you're at in the cycle to make informed investment decisions. My mentor, Rod Khalif, just put out another new book, Passive Investing or Multifamily. I can get it for the show notes, but another great book that it's a revision. It's a second one he's put out. He's basically revised the first version, and it's just a great read in terms of understanding the multifamily process for anybody that's interested.
Yeah. And, I took one of Rod's boot camps and I got a lot out of it, but I think his book, in my opinion, is more digestible. I mean, the boot camp for me it was good, right? I mean, I think everyone's different, but I love that book. So good recommendation.
For the one in Denver a year or so ago?
No, it's kind of during COVID. So it was online. It was just it was kind of handy, honestly. I mean, it was 2 days of just full on 8-9 hours a day on the computer, which is a bummer, but you can get a lot of information pretty quickly, which is kind of my style. I love in-person stuff. I love the conference thing, but for that particular time, it worked really well.
Great.
Next question is, and we talked about this, but coach, mentor, has it been worth the investment?
Absolutely. Short answer, yes. So it's the other example I'm sure you've heard of, you are the 5 people you hang around with. I forget who coined the phrase, but you are who the 5 people you hang around with. So, I say, I go to church on Sundays because I want to hang around those kind of people that are equally yoked and we share the same things in common. And so the same illustration carries forward to real estate, right? If you hang around real estate people, you're going to start talking real estate. You're going to start thinking real estate. You're going to start studying real estate, and you're going to become more and more comfortable discussing that. So you are the 5 people to hang around with. And I think that any of them are, I won't disparage any of them to get started. But I say, if you want to dip your toes in the water, as you said, go to the meetups, the local meetups, plug into some onlines. There's plenty of virtual ones these days. You're going to jumpstart your education in just that. And then if you want to graduate to one of the bigger systems where, you have to spend some $100 to go to a boot camp for any one of those people, you're going to have their boot camps. Go to them. You're going to get on fire or you're going to hate it. It's not hate it, but you'll say, this isn't for me. And like you, I went to the boot camps and I was off. There was no turning back. So yes, highly encourage that continued education.
Totally agree. Yeah. I mean, I actually asked that question about coaching. And so maybe I'll just ask you, have you enjoyed the coaching experience? Do you enjoy being a coach yourself?
Yeah. People say, why do you do it? And it's very simple for me, Eric, is that there's been so many people that have built into me along the journey that I simply want to give back. And yeah, I wouldn't do it if I didn't enjoy it. I make a few bucks, but it's certainly not for the money. And you just, I've met people all across the US, from a truck driver to a multimillionaire. And I just really enjoy it. And sometimes I wonder if I'm providing any value. And then other times, I talk to them 6-9 months later and I got one of the former students living in Michigan and he's off doing great things and probably surpassing me.
It's super rewarding. Yeah. It's awesome to see the,
yeah. It's kind of like seeing your kids grow up.
Yeah, no, I actually do a little coaching myself. And I've really enjoyed it. It's like you said, it's not for the money because there's better ways probably to spend your time hourly, but I think it's definitely a enjoyable experience. I mean, I've really gotten a lot out of it and I've, seen a lot and I've actually grown myself, I think, if I'm being totally honest.
Yeah, and I think today I have people different, I wouldn't call them formal mentors, but people I look at for money raising ideas, people I look at for operations ideas. And now I kind of break it down into the different kind of aspects of it, the marketing aspect of it. So as you advance, you find other experts and you reach out to them like, you and I have, and you'd be amazed what people will share for free if you don't even want to get into the coaching conversation.
Yeah, that's the one other thing I love about podcasting. I get to talk to very smart people for an hour who know more than me, and I just get to interview them. So, I mean, that's one of the things that I love about podcasting is, one, get the word out, because I truly believe in this, educate people as much as we possibly can. But it's selfish too. I mean, I get to talk to people who I get to dig in and learn from. So it's kind of like coaching in that way.
And you get to tell the kids to be quiet for an hour, right?
Yeah. And it's, I mean, it's a double-edged sword. I get to, have a little break, but I do miss time with them. So I talked to Whitney Sewell quite a bit about this, is the sacrifices you make along the way, and make sure that they're in line with what you're going for. So anyway, I don't want to go too far down that rabbit hole, because I could talk about my kids all night. So I won't.
That's good.
The next question I ask is, what's something you've done that you would not repeat that we can learn from you?
What is something I have done that I would not repeat? That's a tough one. Something I have done that I would not repeat. Top of mind, the simplest one is, I would say, is get started earlier than I did. I was kids raised in college, and I waited till I had a few more disposable dollars. I would say the thing to learn from me that I did poorly is not getting started early enough in this journey. Because I got busy raising kids, W-2 job, thinking that I need to maximize all the savings in the 401k and the other investment options. If I had to do it over again, I would put in whatever the company's matching, and all the rest of the money would go into probably real estate.
Yeah, great advice. I love it. Cool. The next one is, and we've kind of done this a lot, but what mindset tip can you give to listeners who maybe are getting started or just kind of need a tip?
It's not profound and it's not new with me, Eric, but the one about mindset is, so I come from a corporate world, and as a young guy, I was an athlete, and I used to do a lot of rah-rah. And so when I came into the real estate world, and the rah-rah kind of turned me off. But the one that it really resonated with me is, I think it goes back to Tony Robbins, is the triangle illustration, with really the simple triangle. Anybody can visually remember a triangle or draw it on a piece of paper, but at the top of the triangle is mindset. So you have to really visualize it's like the Olympic athlete who has to begin with visualizing him or herself on the medal stand getting the gold medal. So you have to mindset wise get your head around, I'm capable of doing 100 doors or 1,000 doors or whatever your goal is. And then on the base of the triangle is really methods and mentorship. So mindset on the top, methods and mentorship. It's that complete triangle. I think that I can have all the great aspirations in mindset, but I may not have any methods, and my mentor is hopefully going to jumpstart it for me and make it come quicker. So that'd be the real tip, the visualization of that mindset, mentorship, and methods triangle.
I love it. It's a great tip. This one's the most challenging to me, at least, is two-part question. Yeah. The first one is, what is your definition of success?
That one's easy for me. I can tell you what success is not for me. Success is not to be known as the greatest real estate investor ever. And that would obviously be a stretch. Eric, I'm just at a season of life where I enjoy this. It's a lot of fun. I make some money along the way, but I really want to be known first as a husband and a father to my 4 children. And I hope at the end of the day, they don't stand over my grave and say, "Ooh, he made a lot of money." I hope that they stand over my grave one day and say, "He was a great dad, and he taught me a lot about life and along the journey." So that would be how I would define success.
Oh, so good. Yeah. I mean, I think I got to align with that. I mean, I always talk about the two kind of motivators for me is time, and with that will come travel. Those are 2 things my wife talks about all the time, is to spend more time at home with kids and my wife. And then alongside that, we love to travel. So I'm motivated by those two things. So I just love the way you put it. So thanks for being honest.
It's the cliche that, your kids are young for a season, and right now you're up to your eyeballs in it and you think it's never going to end. But as the father of four, it goes by so quickly. And so you're absolutely right to enjoy and prioritize that amongst everything. So
yeah, thanks for the tip. I mean, there are times that the days seem very long, right? But no, I hear that all the time. I mean, it goes fast. It's even gone fast. My oldest is 4, and it's hard to believe he's 4 years old. It's incredible how fast it's going. And you start breaking it down. It's like he's nearly a quarter of the way till he's likely out of the house, so I got to maximize my time with him.
And if you believe in the principle that his personality is probably formed before he's the age of 10, you're halfway there.
I know. I better get on it even more.
I mean, so he is by the time he's 10, and you're halfway there. So almost.
Yeah, he's got a monster personality already. So we'll see how this turns out. And then the second part of that question is, if someone asks you, why are you successful and others maybe not so much, what is your response?
I don't really, on that journey of education and learning, I guess I'm successful to somebody, but I still feel I have an awful lot. I think the best is in front of me. And there's a lot more on this real estate journey. But I think if I were to say one of the talents I possess is persistence and education. I'm in this because I want to be, not because I want to make money or because, well, that's a byproduct, but because I like this. I think it's great for people. And I want to get my adult children in this. And so, truly the thought process of giving to the next generation is something that I wish I had done earlier. And you don't have to have $100,000 or $50,000. You can network together, form a trust, an LLC with 3 other people, and come up with $50,000 and invest in one of these things. You can go out and buy a duplex, a quad. And so I think persistence is the, and my wife would say I'm a little nerdy. So with real estate,
it's an added bonus. I'm a nerd myself. I'm an engineer by trade, so I just tend to have that nerd thing anyway.
You love a good spreadsheet.
Yes, I do, and I'm not afraid to admit it. That's great. I mean, this is such a good stuff, and I really appreciate your time. I'm going to ask you one more question. That's actually not a standard question, but what do you foresee in the future? I mean, you're trying to get further in this. Do you have kind of a goal to exit your W-2, kind of see where it goes? I mean, what's kind of your future hold?
Well, if there's anybody from my employer listening, I'll shy away from that question. But yes, I will. I'm older than you, and so there's an end in sight for me within the 3 to 5 year window. And yes, I intend to have continue to get to that place where I can sustain that. And I will stay in this as long as I'm able. And yes, there are competitive market prices, but there are always competitive market prices, and there's still opportunity out there. I want to be in it for the long haul, and I, like you, enjoy a good spreadsheet, meeting investors, and touring properties. I guess it's just
I like it all too. I like basically every bit of this industry, and that's why it's so fun for me. And I agree. I mean, I think the market is tough, but I don't think anyone's ever said, "Oh, it's super easy to find a deal," except for maybe like 2010 or something. But I think it's just a challenging market. But there's absolutely always deals. It's a matter of being patient, like you said, and persistent. So I agree.
It goes back to what's your strategy. You can do this part-time. To your listeners, you can do this part-time. I'm living proof. There are many others too. It's about developing that team, developing those expertise that you may be lacking in. And so when I coach people, I say I don't coach them to. Everybody wants to leave their W-2 job because they have a boss there or a situation they dislike. But I say I don't think you should leave your W-2 job until you can replace your current income.
Yeah, which might be a long road, and that's totally fine. I agree.
If you're $50,000 income or $250,000, that's still a standard rule of thumb. If you got a $250,000 income, you've got more opportunity to invest, and you should be making more money, and blah blah blah. So,
I like it. Yeah, great tip. Well, Randy, been a great show. The final question is, how can people get in touch with you? Where can people reach out?
Eric, it's really been fun. As I said, I really appreciate the opportunity to spend some time with you and your audience. So the easiest way is my website, invest-ark, invest-ark.com. There's a contact us page on there, or if you want to send an info at invest-ark.com. Happy to chat with your listening audience and follow up with them. And if they'd love to, if they want to get on my newsletter and kind of follow me, or LinkedIn, any of those ways are readily available.
Awesome. Thanks again, Randy. Thanks for being here.
Appreciate it, Eric.
Thank you for listening to this episode of the Real Estate Mindset Podcast. If you've enjoyed the content today, please follow this show wherever you listen to podcasts. And don't forget to head over to wildoakcapital.com for more information or to connect with Eric directly. Please take a moment to leave a review or tell a friend about what you've listened to today. We hope you'll tune in again soon.